What's going on, guys? Grab a pen and jot this down. Today we're going to talk about the possibility of a recession, what you need to do, how to prepare, and what to think about for the next 12 to 24 months. Most important right now, I've mentioned before, there are too many levels of uncertainty in both political and local economics. Depending on what nation you're living in, what country you're in, doesn't matter. They're all shaking at the current moment in time. We talked about interest rates earlier this week. We talked about the Russian-Ukraine war. We talked about global trade with China. A lot of this stuff is breaking. So what do you need to do? I've spoken to a couple investors that manage or own 8 figures, 9 figures in capital. First thing they're doing, interest rates are going up, so they're investing cash into fixed income because now cash has a positive return, so it has a trade-off. You need to focus on, all right, preservation of capital. All right, if I don't lose money, at least let me make a positive return. 1, 2, 4%. You can ladder your fixed income investments over the next 6, 12, 13, 14, 18 months and just keep rolling them over as rates rise, change, volatile. It doesn't matter which way they go. You can figure out how to manage them in the short run. But it's better than to have principal equity exposed to the markets where you can't control the downside risk, or it's not worth the downside risk. Maybe it drops by 5, 10, 15, 20%, and then you have less cash. You want to have cash stored up because you're going to have to make investments either to double down on what you currently have, or you just make new investments. So that brings me to point number 2. It's time to find new ideas. The economy is changing, the market is changing. It's no longer a free rate environment. It's no longer a free money environment. So the economics of investing have shifted. So the strategy that worked for the last 10, 12, 13 years since a great recession no longer applies to the next decade's worth of investing. And now you're thinking about, all right, if the rates are going to be up at 4 to 5%, how do the economics of a business change over time? What's the risk-free rate in a specific type of business, whether it's a commodity, industrial, manufacturing, software, real estate? It doesn't matter. But now the macroeconomics of that business have changed, and 2, the cost of capital has risen. So now you're going to ask yourself, is the balance sheet of the investment you're making optimized for the investment that it's currently projected to do over the next 6, 12, 24 months? So if your own, let's say a public company is not readjusting its forecasts like they did during COVID, then you're already, you're not pricing in the downside. And the market is going to do it for you, so the stock will probably drop in price. And now you focus on, all right, before they might have levered up on debt, and it might have been at 2, 3, 4, 5, 6%, and now it's gone up 300 basis points, so up 3%. Maybe they need to raise equity. Maybe they have to be a profitable business. Maybe they have to generate a certain amount of free cash flow they weren't doing before. A lot of companies are cutting off expenses for this specific reason. So now is the perfect time to start readjusting your balance sheet, readjusting your portfolio, and start thinking, how are you going to make a sharp 180-degree turn in the next 12 months if things change quicker than you anticipate?